All right, if you've ever banged your head against a desk trying to figure out variable costing versus absorption costing, you are absolutely in the right place. In this explainer, we're going to tear into the source material to finally clear up the biggest differences, the exact costs, and the formulas you actually need to know.
Let's dive right in. By the end of this, you are going to completely master the difference, the costs, and the formulas. That is the holy trinity we're locking down today.
Part 1. The Product Cost Basics.
Before we get into the weeds, let's just quickly answer the million-dollar question. What actually is a product cost? How do we define it? Think of a product cost kind of like a physical journey. It's a three-step process. First, the cost is incurred to literally manufacture the product, right there on the factory floor. Then, step 2, that cost effectively attaches itself to the product and becomes inventory, sitting securely in a warehouse. Finally, step 3, when a customer actually buys that product, the cost moves out of inventory and officially becomes cost of goods sold on your income statement. It's a journey from the factory to the warehouse, straight to the final sale.
So what's actually in that bucket? Well, there are three basic product costs we need to mentally separate. First up, direct materials, the raw physical stuff. Second, direct labor, the actual hands building it. And third, manufacturing overhead. That's your factory rent, the utilities, basically all those indirect costs. Keep those three neatly compartmentalized in your head.
Now, here is the absolutely crucial point. That third category, manufacturing overhead, it actually splits into two very different animals. We've got variable manufacturing overhead, which goes up or down based on how many units you pump out. And on the flip side, we have fixed manufacturing overhead. That one stays exactly the same. Think factory rent. Your landlord expects their check whether you make one single widget or a million of them. And this exact split, this is where variable and absorption costing completely part ways.
Okay, part 2. Let's meet the costing methods. We have variable costing up against absorption costing, but a quick heads up from the research, you're going to see alternate names out in the wild. Variable costing loves to go by direct or marginal costing. Meanwhile, absorption costing is famously known as full costing. Make sure to jot those down side by side so a sneaky vocabulary swap on an exam doesn't trip you up.
Let's unpack variable costing first. What's inside? We've got direct materials, direct labor, and variable manufacturing overhead. Pretty straightforward, right? But take a really close look at what is completely missing here. Fixed manufacturing overhead is absolutely nowhere to be found. It's totally excluded from the product cost.
Now let's see how this builds under absorption costing. We've got direct materials, direct labor, variable manufacturing overhead, and here's the kicker, fixed manufacturing overhead. The name kind of gives it away, doesn't it? Under absorption costing, nothing gets left behind. Every single manufacturing cost is fully absorbed into the product.
Which brings us to part 3, the one big difference. When you're analyzing this stuff, honestly, it all boils down to one massive question you need to constantly ask yourself. Where is the fixed manufacturing overhead? Literally everything in this entire topic revolves around how you treat that one single cost.
And here is the big reveal. Under variable costing, fixed manufacturing overhead is treated strictly as a period cost. What does that actually mean? It means it is expensed immediately on the income statement during the period it happens. It totally doesn't matter if you produced 1 unit or 10,000. Boom. It's written off as an expense right away.
The contrast here is just wild. For variable costing, fixed manufacturing overhead is a period cost, expensed immediately. But for absorption costing, it's treated as a product cost. That means it gets trapped inside the inventory on the balance sheet, just hanging out there until the product is finally sold. This one single divergence dictates exactly how your profit looks at the end of the month.
All right, let's get into part 4, formulas and income statements. Let's compare the math directly. For variable costing, your product cost per unit is just direct materials plus direct labor plus variable manufacturing overhead. Super easy. But for absorption costing, it's the exact same base formula, just with one massive addition tacked onto the very end. You add allocated fixed manufacturing overhead per unit. That little extra tail on the equation, that is the defining difference.
Because these costs are treated differently, the income statements have to look different too. Let's break down the contribution margin income statement. This layout is exclusively used for variable costing. You start with sales, subtract variable cost of goods sold to get your variable gross margin. Then, subtract variable admin to land at your contribution margin. That specific term is super important here. From there, you finally subtract all your fixed costs at the bottom to reach net income. Notice how fixed manufacturing overhead is just dumped down there in the fixed cost bucket, completely detached from the product?
And this brilliantly illustrates the contrast. Consider the traditional income statement, the one used for absorption costing. You take sales, subtract cost of goods sold to get your gross profit. Catch that terminology? Gross profit, not contribution margin. Then you just subtract selling and admin to get net income. So where on earth is the fixed manufacturing overhead here? It's secretly hiding inside that cost of goods sold line, catching a free ride with the physical inventory.
Let's wrap this up with part 5, memory tricks and a quick recap.
If you ever need to reverse engineer a problem, the source material gives us 2 incredibly simple phrases to lock into your brain. For variable costing, only variable manufacturing costs stay with the product. For absorption costing, all manufacturing costs stay with the product. Variable means variable only. Absorption means all. Memorize those 2 tiny phrases, and you can honestly logic your way out of any scenario.
Let's rapidly consolidate everything we've unpacked in the last few minutes. Point 1, watch out for alternate names like direct or full costing. Point 2, the treatment of fixed manufacturing overhead is the key to the entire kingdom. Point 3, variable costing pairs with the contribution margin, and point 4, absorption costing pairs with gross profit.
So, now that you've totally mastered the mechanics behind fixed manufacturing overhead, think about this. Which costing method actually makes the most sense for your business's internal reporting? Does your management team need to see costs grouped by how they behave, or do they need fully loaded product costs? Think about how this math actually impacts real-world decisions. Thanks for hanging out with me for this explainer, and I'll catch you next time